Americans live in what can only be described as a credit card paradise. In just a few minutes, an 18-year-old with no job, no credit history, and barely any verification can gain access to $1,000 real without leaving their living room. Applying usually requires nothing more than a date of birth and a social security number. When it comes to income, banks often operate on something close to the honor system. Decisions are fast, sometimes instant. And if that same teenager manages to pay the balance in full every month, or even just turns on autopay, something remarkable happens. Within 6 months to a year, they're suddenly labeled prime, or even super prime, by the mysterious forces behind credit scores. That status unlocks an entirely new world. Cash back on groceries, rewards on travel, discounts at restaurants. Simply by using a card for everyday spending, things they were already going to buy, a reasonably savvy consumer can earn hundreds of dollars per year. And since rewards aren't taxed, that 5 or 6% cashback feels more like 8 or 9% in real terms. On top of that, many cards come loaded with perks. Free airport lounge access, streaming subscriptions, travel insurance, ride credits, grocery delivery, and more. For people willing to spend extra time applying for new cards, the rewards don't stop at hundreds. They climb into the thousands through so-called welcome bonuses. It all sounds incredibly generous. After all, who would willingly lend money to an unemployed teenager over the internet with no collateral and no guarantees? Certainly not for free. Which brings us to an important rule of business. When a massive corporation appears generous, especially one with a familiar banking logo, it's worth looking closer. Because generosity at that scale almost always has a cost, and someone is paying it. For every cardholder enjoying a free international flight, there's another still paying high interest on an expense from years ago. That's why so many personal finance experts warn people to avoid credit cards entirely. They combine high interest rates, extreme convenience, and psychological tricks that make spending feel abstract, like casino chips instead of real money. And because credit cards allow revolving balances, debt can quietly grow month after month. This is the dark side of the system. At first glance, it seems obvious what's happening. Responsible users get rewarded, while irresponsible users subsidize them through interest and fees. But there's a problem with that explanation. Large corporations don't willingly lose money on their best customers. If they did, they wouldn't survive. Credit card companies may be ruthless, but they are not foolish. In fact, if high credit score customers truly cost banks money, those customers wouldn't be flooded with offers and premium cards. Banks are not charities for wealthy people. There would be no reason to overcharge some customers just to reward others when they could simply profit from everyone directly. And that's exactly what they do. While banks will happily wait years for someone to miss a payment so they can charge interest, interest alone isn't their best business. There's a limit to how much money you can extract from a struggling borrower. The real profits come from something far more reliable: every single transaction. The biggest myth about credit cards is that paying your balance in full means you're beating the system. In reality, the most profitable customer is someone with perfect credit, who always pays on time, and who uses a premium rewards card for everything. Here's why. When you buy something as simple as a banana, your money doesn't go straight to the store. It passes through multiple intermediaries: your bank, the merchant's bank, and the payment network that connects them. Each one takes a cut, simply for moving numbers across the internet. Those cuts, known as interchange fees, are enormous. They're so large that, at one point, a major US retailer spent more on these fees than on healthcare for hundreds of thousands of employees. Interchange fees include a fixed cost per transaction plus a percentage of the total purchase. That fixed cost is why small stores sometimes require a minimum purchase for card payments. It can wipe out their profit on small transactions. But the real money is in the percentage. Taking a small slice of nearly every purchase in the country turns out to be incredibly lucrative. While consumers might earn a couple percent back on groceries, banks earn a cut on everyone's groceries, gas, travel, dining, everything. Card companies argue that these fees are justified because cards increase spending. Payments are fast, convenient, and delayed. Rewards also encourage people to spend more. Merchants accept higher fees hoping they'll be offset by increased sales. But there's a limit to that logic. American Express realized this earlier than anyone else. While Visa and MasterCard focused on being accepted everywhere by keeping fees relatively lower, Amex took a different path. It stopped competing for merchants and focused entirely on attracting wealthy customers. It raised interchange fees dramatically, then used that extra revenue to offer lavish rewards. Those rewards attracted higher-income cardholders, who naturally spent more money. More spending generated more fees, which funded even better rewards. The cycle fed itself. Over time, this strategy produced ultra-premium cards with massive annual fees. Cards owned by people who spend heavily and generate enormous transaction revenue. Amex didn't need to be in everyone's wallet. It only needed the small percentage of people who do the majority of spending. But this created a rewards arms race. Competitors were forced to offer similar perks, pushing benefits to increasingly absurd levels. At some point, it became clear that these rewards weren't causing people to spend more. They were simply attracting people who already spent more. And the costs didn't disappear. They were quietly passed on. Merchants can't charge different fees based on which card you use. They're restricted by card networks, which means the easiest solution is to raise prices for everyone. That means people paying cash, often lower-income customers, end up subsidizing rewards for wealthier cardholders. Studies have shown that cash-using households lose money every year through higher prices, while card-using households gain substantial value through rewards. And the wealth gap makes this worse. Higher-income consumers use credit cards far more often, while lower-income consumers rely on cash or debit. In effect, the system transfers money upward. Merchants dislike this arrangement, but few are willing to challenge it. Refusing major cards risks losing customers. That leaves regulation as the only real solution. Other countries have already taken this path. In much of Europe, interchange fees are capped at very low levels. As a result, credit cards offer far fewer perks, and far fewer people bother owning them. The system is simpler, cheaper, and less distorted. The United States could do the same. It already has debit cards. But credit cards remain untouched, largely because the true cost of rewards is hidden. Consumers see points and perks, not the higher prices they help create. And as long as that remains invisible, the system continues exactly as designed: highly profitable, deeply unequal, and remarkably resilient.